Hello and welcome to Edison TV. Today I'm joined by Martin Davis, CEO of Molten Ventures, a well-known London-based venture capital firm that invests in the European technology sector and currently has around 70 portfolio companies. Molten Ventures has recently published its final annual results, so we thought it would be a good idea to discuss the key developments in the fiscal year 2023 and the near-term outlook. Martin, thanks for joining us today.
Good morning. Very happy to share our results and to answer your questions.
Can you maybe start by discussing the performance of your underlying companies in FY23 in terms of revenue growth and new funding rounds?
Yes, of course. It's really been, I think, certainly as far as the valuations go, it's been a year of two halves. At the first half, we took some fairly, with the public markets down, we took some fairly dramatic drops where the NAV was down 17%, which we announced in November. But in the second half, we've seen a degree of stabilisation. And so at a constant FX level, we've just seen 2% drop. So we've seen that stabilisation coming across in the second half, which is very much in line with what we've seen within public markets and very much mirrors what we've seen across our portfolio companies. You asked specifically about revenues. The thing about our portfolio companies is that they're all innovating in an area that is in high demand. They're solving real today's problems for enterprises, particularly that need those problems to be solved. And as a result of that, last year in the calendar year, we saw revenues up across our core, which is the majority of our portfolio in fair value terms, by 40%. Which even in last year, with a lot of people taking cost control measures, was very impressive. But in this year, they're forecast to be up by in 23 by 65%. So again, a lot of forward momentum, a lot of demand for our portfolio companies' services across the board. You also mentioned funding rounds, and I think it's been a very interesting period for funding. It was a very difficult environment last year. It's still a difficult environment. But for tier one assets, for those assets that have got momentum, then they can continue to raise. And indeed, our portfolio raised over $1 billion in funding over the last 12 months. And we saw some very significant raises of the likes of Ivan, Coach Hub and Ledger, all raising in excess of $100 million. But also in Series Cs, but also we saw some smaller Series B funding much more recently this year. A few months ago, we saw Riverlane, exciting company in the quantum computing area, and Evenetics, both raising Series Bs. So we've seen a reasonable amount of raises over the year. And certainly the important thing for us is those raises, 90% of that money raised has been raised at a valuation that is at or above NAV, which is a very encouraging sign.
Thank you. And to what extent have the secular growth trends underpinning your portfolio companies been impacted by the current difficult market environment?
Yeah, look, it is very difficult out there. I think when we talk about our outlook, we talk about being cautiously optimistic. We're optimistic because of the quality of the portfolio and the solutions they're solving. We're cautious because we operate in very difficult macroeconomic period, and there's geopolitical factors coming in to play as well. The reality is that macroeconomic factors, interest rates, for example, they do matter and they do affect sentiment in the sector. And so therefore, it's been a very, very tough environment. And I think, once the outlook for rates gets a little bit better, we've seen a lot of talk about that recently, and it not getting as good as people thought. So that shows that there could still be bumpy waters, a bumpy road ahead of us. But overall, what we try to do is we try to focus on the performance of the portfolios. And if they continue to grow, as I said, grow revenues by 65% this year, despite the tough macroeconomic environment, if they continue to grow their businesses and continue to move towards profitability, preserve their cash, then actually we think they're in a reasonably strong position. But now is the time, with this difficult period, now is the time for the best companies to remain focused, continue to grow, and they will come out of this period much, much stronger.
Thank you. So we've already touched upon that, but maybe you can discuss in more detail what has Molten done to mitigate the difficult market environment for technology companies we've seen recently.
Yeah, well, we can't change the market environment. Obviously, all we can do is focus on what we can control. And so we work very closely with our founders. We've really been working with them over the last 12 months to help them to focus their efforts and their costs on those parts of their business that are going to drive growth. We want our companies, and their companies want to continue to grow, and so therefore we want to support them in that. Having said that, we've been working with portfolio companies to look at their cash flow forecasts, to look at their cash runways, to think very carefully about when they need to raise the next round of funding, what the hurdles that they need to hit in order to get out to be able to execute that funding round, as I've said, as to be as successful as the ones we've had in the last 12 months. And so therefore working with our founders who may not have been through a downturn, a number of the younger ones may not have been through a downturn of this nature. So getting them to get up work on their costs, to make sure that they manage their cash flows, work towards profitability, and critically extend their cash runways. And so we've really been, that's the work we've been doing really for more than the last 12 months. We kicked off this work in kind of March last year, and we really started to see the benefits of that with 80% of the portfolio with 12 to 18 months cash runway. I think that shows that we're really starting to see the benefits of that work.
Thank you. And how is the mood in the VC industry now? I mean, obviously, we've seen some optimism around generative AI, but what is the investor sentiment more widely?
Yeah, I think the mood music was very cautious last year. The entire environment was very uncertain. But I think certainly our portfolio companies, they are in those areas, as I've seen, they're seeing impressive growth. They're being a little bit more cautious. But the reality is that the companies, the problems they're solving in the market, and the macroeconomic environment, all that's doing is meaning that enterprises in certain areas of development, whether that be health tech or climate or deep tech, if anything, those are more important, because most of the technology that our founders and the businesses that they're working in, most of them, they're solving problems like helping companies to reduce costs or to manage their costs, to increase efficiency, to help them manage or protect their data. All of these sorts of areas are becoming more important to enterprises, and they're deploying more capital to get technology to solve those problems. So overall, I think the mood music is, I would also say, cautiously optimistic. Look, our founders are naturally optimistic. They're in businesses that are growing and doing very well, so you would expect them to be buoyant. But I think there's also this cautious optimism that they realize it's a very difficult environment. Overall, I would say the mood music is pretty good. We're seeing some of the technological advances like generative AI. There's been a lot of talk about that in the press over the last few months. Now, these capabilities bring something more to our companies, and nearly all the founders I talk to are, we invest in innovators, and nearly all of these founders are using these rapid developments to help them to solve problems for companies faster, better, cheaper. And so actually, I think a lot of what we're seeing in the technological advances, for example, generative AI, I think those will help our portfolio companies. Now, we have a number that are very specifically in the AI space. That tends to be around maybe protecting or enabling AI models. And I think that's very encouraging as well. So they're obviously in a very exciting place. So overall, I think the mood music is very excited about the development and speed of development of technology. I think they're very excited they can bring that technology to solve today's and tomorrow's problems, and therefore overall the VC market and the entrepreneurial environment is still quite buoyant.
Thank you. That's very helpful. Now, during the latest earnings call, you've mentioned that you continue to prioritize cash preservation, but at the same time that you're still well positioned to capture new attractive investment opportunities. So maybe you can shed some light on this.
Yeah, look, I think it's very important that as much as we help our entrepreneurs and the companies to manage their own cash flow, it's important that we take our own medicine. So we as well have been being very cautious and careful to make sure that we manage our own cash flow. And so therefore, we also work on the same basis as we ask our portfolio companies to work on. We look for a 12 to 18 month cash runway for our own company. And first in that, we obviously look at the capital is going to required to follow on within the companies to at least preserve the value in the NAV. And that's our first objective. And we've disclosed for the first time this year that because of the detailed work we've been doing with the portfolio, we're very comfortable that that number will be about 20 million. Now, when you consider a portfolio of over 1.3 billion, 20 million is a very, very small amount. And the reason for that is twofold. One is that we've plowed a lot of capital and well capitalized these companies very well over the last couple of years. But also we've helped them to extend their runways more recently. And so our capital requirement to support them is relatively small. Then we have our own GPLP requirements. And of course, then we have our own operating costs. So we roll all of those in, and we're very comfortable with the liquidity that we've disclosed in our results, that we've plenty of capital to see that through. But I think your question was more about, well, how do we invest and how do we spend more money and maybe take advantage of a buyer's market really for assets? And that I'd answer in two ways. Firstly, we have third-party capital, ES, VCT money, and some other source of capital that allows us to continue to invest whilst continuing to preserve PLC capital. So I think that's one way. And then, of course, our cash runway projections are always on the basis that we assume no realizations. And indeed, we always have realizations. So that allows us to generate more capital to plow back into these companies. And indeed, we've already announced a post-balance sheet date realization of a relatively small amount of Early Bird 6 fund. That cash is coming in, which is an example of why, even though our cash flow projections internally work on no realizations, we know there will be some, and we can use that money plus the surplus cash we have to be able to plow back into exciting companies. And the reality is there are still interesting areas for investment at this stage of the cycle.
Thank you. And finally, there are some initial signs of stabilization in terms of valuations with the portfolio. You've mentioned that 2%, just 2% decline of gross portfolio value in the second half of the fiscal year. So maybe you can discuss how comfortable you feel in terms of your current portfolio valuations and how much downside protection you have from the liquidation preferences, as well as discounts applied to valuations plus funding rounds.
Yeah, so I mean, this is a really important point right now, but it is something that's inherent in our model. We're a portfolio business, which means that we want to get our money back in every asset that we invest in. And we spend a lot of time with our team working on making sure that, as much as we'd love every one of our investments to grow by 10 to 20 to 30 times, we know that that won't be the case in every case. So what we want to do is we want to make sure that we can get our money out in every solitary asset that we invest in. We believe by making all the investments work for us and for shareholders, it means that's how we are able to deliver much more stable fair value growth over a much longer period. So since listing, we have a target of 20%. Since listing, we've actually delivered 35% fair value growth year on year through the cycle, and we do that by managing the entire portfolio. Your question is quite right that the downside protection that we have inherent in the model through our use of the preference shares is something that's really, really important to us. About 97, I think it's 97% of all our investments have this protection. It's very much part of our model, and about 55% of our fair value sits at the pref stack. At pref stack value. So we have a large amount of the existing investments and a large amount of our existing NAV that is already underpinned by this really important downside protection. The other question you asked was around discounts to rounds. Obviously, this is an area that is very difficult. You know, our investment philosophy and our valuation philosophy is very much to value assets at the value that we believe they hold today. And in some cases, people will invest in companies based on forward projections. What we like to see is we like to base them on where we see the business today, and then based on commercial traction or indeed proof points, that enables us every 6 months to walk them up, quite often back up to the most recent round. And so we have about 65% of the fair value companies that work on fair value have some sort of discount applied. Those discounts can range anywhere from 6 to 75%. So the range is quite large because, of course, some will be raised at a very high valuation. So the range is very high. When you look at a weighted average across the portfolio, that's at 35%. So we're not saying that those last rounds are not correct or that they're not fair. What we're saying is that for our model and for our valuation methodology, what we like to see is we like to see the proof points, commercial traction delivered, and then if necessary, we can walk them up to those rounds or indeed walk them back. It's very important for us. We try to get ahead of any bad news coming out of our portfolio companies and obviously behind any good news. And that enables us to get a much fairer value across the board. I think what it also means is we probably have a smoother trajectory on our valuations on a 6-month basis. Now, despite the fact that there's been a reasonably significant drop year on year from last year, as I said, we took most of that in the first half. Overall, compared to the ups and downs of the markets, particularly the public markets, our valuations have been much smoother. And I think that's partly because we take this approach of wanting to see the commercial traction and moving stock up and assets up and down in a more methodical manner. So that's where we sit overall. I think you also said how comfortable are we with valuations? I mean, we clearly are. We have a very disciplined and thorough process. We have a separation between the investment team and the finance team that works out the valuations, that signs off the valuations. We have, as a FTSE 250 company, we have an independent, obviously we have independent auditors, and we've got an independent board that challenges. So we're pretty comfortable, despite the discount where the current shares are trading. We're pretty comfortable that our assets sit at the right values for where we are right now and where those individual companies are.
Martin Davies, CEO of Molten Ventures, thank you very much for your time.
Thank you.